My name is Joe Scarlato. We're hosting this panel here, specifically Roundtable. Wanted to firstly thank our guests, three individuals who I respect, who I've worked with for a long time in this industry. One of the things I do want to bring up is obviously the discussion here is to breed interest in these topics for the mining sector. We have a lot of our competition on, other brokers are on, and Ryan's kind enough from Lockton to represent Lockton. We're going to be talking generically about the industry, not about any specific insureds or any specific cases. We've had some specific topics that we've been really interested in and wanted to kick around a bit today. We attended RIMS, and I saw a need in that room for some further discussion. So I'll let everybody introduce. So Ryan, why don't you introduce yourself to the team, to the group here?
Sure. Ryan Brown. I lead the mining practice for Lockton. I've been there 11 years and based in St. Louis.
Perfect. Dr. Chris?
My name's Dr. Chris Snee. I'm a mining engineer, a geologist and scientist. Background in deep coal mining, but was where I started. I've been working in the industry now for over 40 years, and particularly dealing with major losses that have a geological aspect to them.
Thanks, Chris. And last but not least, from Sydney, Australia, Mr. Tony Lavin.
Good morning, everybody. Yes, it's 1 o'clock in the morning in Sydney, but I thought I'd stay up and participate in this for Joe's benefit. I'm a long-term engineer. I have a disaster management business based in Singapore. I have worked for the last 30 years within the insurance industry as a consultant, specializing in helping to mitigate losses when they've got big business interruption exposures. That's both technical and logistics. And Joe and I have crossed paths many times on major losses, particularly in the Americas.
Perfect. Thanks, Tony. So welcome, everybody. I appreciate everyone taking time to join us here. Obviously, mining is a very specific topic, very specific industry, niche industry. As you can see from the agenda, we're going to touch on some of the ESG topics, specifically the environmental response. If you have any questions, you could chat them in. We can try to get to everybody's questions and comments. The one that we really are going to be focusing on quite a bit is the second topic, which is the maintenance issues. We really are seeing an impact, both from an inflationary standpoint, logistics issues, and just general labor force restrictions in the world of mining, specifically with replacement parts on these large scale machines. And we'll hit that. And then the last topic is close to my heart because whenever an insured has a loss, and for those that, full disclosure, I've worked for both captive insurance companies and for the market, high grading is always brought up. It's the first thing someone asks, especially a generalist in mining, doesn't really have the understanding of that specific operation. They'll bring up high grading. They'll ask us, hey, ask them about high grading. Are they high grading? Can you look at the data? And I just wanted to touch base on that, more specific to today, because a lot of these claims are taking longer than they should because of the second issue, the maintenance issue. So with that being said, let's kick it off. Danielle, why don't you kick off the ESG portion of our discussion?
Great. Thank you, Joe. And thank you, everybody, for joining us this morning. We really appreciate your time. We're going to kick off with ESG, environmental, social, and governance. We're going to touch upon some topics that fall under this, under ESG, and then we'll delve into some of the developments in this area and the impact on the mining industry. So along with some of the obvious environmental factors in areas such as climate change, biodiversity, resource use, and pollution, to name a few, ESG also includes social issues that have been raised with human rights, labor practice, safety concerns, community concerns. For instance, in the diamond trade, the Blood Diamond Human Rights Watch, community concerns, an example here in the US, community concerns surrounding the Bingham Canyon mine in Utah. We'll get into the governance aspect with corporate governance, compliance, and lobbying. But as Joe said, let's really focus on the environmental aspects, which is driven by the Paris Agreement on climate change and the worldwide effort to reduce GSGs. It's interesting how that's impacting companies that are required to be compliant with these growing regulations. So seemingly the industry has experienced years of capital constraints and underinvestment. Now companies are faced with not only an increase in demand for minerals to support renewables, renewable sources, but also the expenditures necessary to respond to these various aspects of ESG. So Ryan Brown, we brought you in today. You're very well versed on this topic, and we're really interested to what you can lend to how, from the broker's perspective, how this is impacting some of your clients and what you see.
Yeah, no, thank you, Danielle. It's something, ESG concern around access to capital. So whether it's institutional shareholders and companies that used to invest in those with a large carbon footprint, to now you're seeing it over the last 5 years, the number of insurance companies that have taken positions around those in specific industries, be it coal, be it fracking, anyone in that chain. You're really starting to see a constraint in terms of those organizations that are really applying pressure to insurance companies, whether it's surety, property insurance, the governance aspects, and looking at D&O coverage and who they will and won't write. And so it's something that if you're in the space, if you're in mining, whether or not you have a very large carbon footprint, we're advising our clients it's something they need to be aware of, that the world is getting smaller, not larger, in terms of those that are providing risk capital. We're also seeing increased demand for underwriters, specifically wanting to know what companies are doing to address these issues, how they're engaging with stakeholders, whether they agree or disagree with your platform and your investments. So yeah, we're seeing a lot of focus kind of in a 360 view around it.
Let's get into talking a little bit about, does anybody want to cover or comment on any of the tailings dam collapses and some of the impacts we've seen with that, maybe specifically Brazil in January of 2019, and what ensued and the impact on the environment relative to that particular incident?
What about changes, Chris? Is there any predominant changes in constructing a mine now? Have these tailing dams issues brought in a need for change or that kind of aspect of it?
Well, not being too philosophical, we have to change all the time, and not standing still. And I'm not a tailings dam expert from the point of view of the soil mechanics of it, but as a practicing miner, tailings are part and parcel of what we do. And this not just Brazil, but there is a legacy of tragedies by mismanagement of the tailings, and it does bring into question, how we are designing them. When I used to work for one of the eminent mining consultants, we had the tailings division of the smartest people you'd ever come across, which is why I stayed out of it. But it was very heavily controlled. It was very disciplined, very high levels of education and experience. I have to say that some of the mines that I've visited recently, I've been distressed at the level of engineering that has gone into the tailings. There's been a lack of it, or it's been lacking in some way. These tend to be in less developed places, certainly I think we've taken the foot off the gas, shall we say, in terms of control of some aspects of mining, and the tailings, is part of it, and particularly when you get into some of the more illegal mining that you see in parts of the world.
If I can comment, what we've seen, we've got a number of property markets on the call today, And similarly, as you've seen in a property submission over the last 30 years, you see an independent engineer who gives a risk quality assessment that is going through the underwriting process to assess risk and effectively form some opinion around what a loss expectancy could look like should a certain situation happen. We're starting to see that level of detail and need for tailings dams requirements. So whether it's property or liability coverage, we're seeing a demand for increased knowledge. And before, it was just a data sheet that you'd see an Excel document that showed the size of the impoundment, the age of it, and how much more useful life there was to it. That was all an underwriter had, and you could get coverage for it. Fast forward to today, and you see lots of technical information around the design, the maintenance of it, how weather patterns have changed and impacted soil conditions and so forth. So you're seeing a lot more demand for insurance, or demand for the information to form an opinion around the quality of the tailings and frankly the size. So it's, I would say the pendulum swung. It went from not having any information to now, regardless of size, they want to see everything. And so we're trying to find some balance as to the smaller impoundments really don't pose an issue, but everyone has a big target on them.
I think part of that, and it's not necessarily part of the ESG topic, but I do want to segue into the values. One of the things that, based on what you just said with the assets and the way that they're looking for the detail on operations, and maybe Tony, you can comment on this, or Ryan, but we're finding that both from an insurer's and an insured perspective, values are really difficult right now. And values at risk are really hard for us from a forensic accounting perspective to quantify, because things like, spare parts, things like operational schemas that are different because of lack of labor force. We're seeing that the BI values, not only just assets and physical construct of the mine, but the BI values are tough to quantify these days, because I wouldn't go on the record and do a calculation on a BI value knowing that they have no spare parts for a SAG mill that has some maintenance issues, right? Because if it's a loss, it's going to be a much bigger number than any exposure calc that we could do. So, from anybody in our panelists, as far as what you've seen, and then maybe we'll segue into this maintenance issue, Carlos, I think, because I think it all plays in. But I know that at Ryan's conference coming up, our Lockton's conference that we support, it's a great conference for the mining world. And large losses that, I want to make sure that this is discussed, because it's something that is concerning to me.
Yeah, absolutely, Joe. And I think that's a great segue into the issues that we've been seeing lately with COVID. As we all know, COVID has impacted many industries worldwide. And in our experience, I think it's important to touch on three particular ways where we've seen this impact. Primarily, first and foremost, I think the most immediate and direct impact is on the personnel itself, whether that be limiting or reducing the personnel, or implementing social distancing or new protocols, or even relocating the mining personnel. All this limits the mining's operational ability to efficiently maintain adequate maintenance procedures. And all of this obviously comes at an additional cost. Secondly, I think you have the impact on production as well. Production of mines were severely impacted due to both the shutdowns and the fluctuating demand of these minerals, like that of, for example, the Polish mines, which were forced to halt production for 3 weeks as a result of personal infections. But prior to that, they had already been reduced to about 30 to 50% capacity. All this obviously impacts the bottom line. So while having to increase efforts in testing and providing PPE and implementing new and potentially more costly protocols and procedures, the incoming revenue during this period, at least temporarily in certain instances, has certainly diminished. And then I think finally you have the disruption in logistics, which has an associated inefficiency and delay, particularly at certain ports. Which only really exacerbates the supply line. For instance, Tony we recently worked on a mining loss where we had to prepare a scenario for potential repair and replacement of a GMD, and we saw these very real issues in our analysis. So, in your opinion, and from your perspective, how did these issues play into the operations and the maintenance of a mining facility? I guess is the question.
Yes, look, in Australia, we've been a little bit insulated from the from some of these fluctuations. We've been lucky enough to keep our operations going, and in fact, quite a lot of them have had record productions through this period, just through demand. But a lot of the operations that we see here are remote. A lot of them have been working on fly-in, fly-out bases. Australia's had some fairly severe lockdown restrictions over the last couple of years, and that's caused over a period of time a lot of people to decide they don't want to be in the industry anymore because they either haven't been able to travel, or they've been traveling and then gotten stuck in other places and haven't been able to go home. It's not just limited to Australia. I was on a job in Saudi in the mining industry just recently, where there were a group of South Africans running a gold mine who were normally 2 months on and 1 month off, who had spent the entire 2021 in the Saudi desert because of the lockdown restrictions in Saudi wouldn't allow them to leave the mine site and go to the airport and go home to South Africa for a break. That was not only limiting them getting out, it was limiting them getting specialist people in. So specialist maintenance tasks that required non-destructive testing people or things like that just weren't getting done because the restrictions were preventing it. And we're seeing a huge amount of disruption in the logistics area, both in the supply, but also in the transportation logistics. And it's not just from COVID, it's also coming out of the Ukrainian issue now, where specialist steels and things that were in plentiful supply out of Ukraine are no longer available. If the suppliers of the equipment for the mines can't source that material from them, they've got to go and find it somewhere else, and they're competing with everybody else. So there's shortages in supply. We've had mining losses where we've been able to put things on Antonovs, either the big one, which was destroyed, or the smaller ones. And you can turn months of transit time into days. And particularly when there's big BI numbers involved, that's crucial. Right now, anything that used to travel on the Antonov 225 just has no option now but to go by sea. And if you want an Antonov 124, the vast proportion of the fleet, of the commercial fleet, is Russian based and is on the ground, either impounded in Canada and other countries or stuck in Russia, not game to leave in case they might get impounded. Antonov Airlines themselves have 6 aircraft, I think, that are flyable at the moment, but most of them have been used by the Ukrainian government for either humanitarian or military use. We're just starting to see the occasional aircraft being offered on the market, but they're few and far between, and that means that all of these oversized components that were capable of being carried on an aircraft are now having to be carried on ships. And the chaos in the world with container traffic at the moment has led to a lot of the world's heavy lift ship fleet, which would be used for this sort of thing for getting equipment to distant mines. They're now being loaded up with shipping containers because the owners can make more money carrying shipping containers than they can carrying heavy loads. So the vessels are in shorter supply, takes longer to get one, and then you may not be able to get one that can do a direct sail from port of origin to port of destination. You've got to go on the all stations service, and that can add days or weeks to the transit time on these vessels. And when you're burning $250,000, $500,000 a day, it suddenly adds up to big numbers. Some years ago, we did a generator for a power station in a mine in Western Australia. And we got the generator from Prague to Perth in 3 days using the Antonov 225. The alternate was 65 days by barge to a port in Germany, and then by heavy lift ship from Germany to Australia. So you're talking 60 plus extra days on the BI on a very large loss. All of this is impacting on what's going on at the moment, and we've also got the situation where things are going to get more chaotic, hopefully soon. We've got the COVID issue in China at the moment, and Shanghai has been locked down. There's lots of press about the port operating, but there's one problem with that. The port's operating, but the truck drivers can't operate to bring containers to the port or take loaded containers away. So there's a huge interference with the global container traffic at the moment, with vessels that are loaded with containers for China that can't unload and then can't pick up cargo and go elsewhere. So record pricing on containers in and out of Asia suddenly went to very low rates, but only because there was no traffic in and out of the Shanghai ports. As soon as that restarts, things will just go even more chaotic. So there's all sorts of influences going on at the moment that are playing a role. And probably the scariest one is an exercise I became involved in just recently, looking at a new power project in Uzbekistan, where all of the equipment was coming out of Japan. It was going on heavy lift ships through to the Black Sea, and then it was to go via the Don River and a canal which links the Don and the Volga through to the Caspian Sea, offloaded in Kazakhstan and driven 2,000 kilometers by road from there to the project site in Uzbekistan. That route's now unavailable for a project that's got $1 billion plus capital investment, and there is no physical alternate way of getting them to the site. And similar things could be faced in the near future with mining projects, if there's major equipment needed to be moved into, particularly if there's breakdowns or that sort of thing. So there's lots of factors playing a role that make it very difficult to quantify what the exposures of the insureds and the insurers are likely to be.
Thank you, Tony. Ryan, I'm going to go ahead and ask you, what do you think this impacts in terms of valuing assets for mining operations, particularly as it pertains to inflation, which we're seeing is going wildly out of control? How do you see it from your perspective as a broker?
Carlos, it's a great question, and it's something that we're seeing. While if you're a mining company today, you're enjoying some good commodity pricing, right? We've been in this nice run up for very many commodities for a long time. There's really no end in sight given demand and some supply constraints depending on the commodity. The challenge that you have when we're sitting down with clients and is we're looking at going through a renewal process, representing values, and that goes into, frankly, setting limits, getting comfortable with measuring your risk before you go look to transfer it. And we're having conversations where people's payroll are up 30%, their production's up 20%, their revenue is up, by a large number, and their PDs are reported as flat. And so we're scratching our head saying, gee, how is this happening given the supply constraints that we're seeing? And so you're seeing a concerted push by insurers to say, we want to understand what property values are. How did you arrive at these? Where they're not taking status quo or a couple of points of small inflation. And again, we're advising clients that, in an empathetic way, over the last 36 months, we've seen insurance rates continually spike, right? The market's hard, it's been correcting. And so you've got this rate environment that's very punitive, that doesn't necessarily encourage going out and spending additional money to value PD. not to mention BI concerns that you're talking about. And so it truly is putting a risk manager hat on to say, before we talk about insurance, let's understand our risks. And as Tony mentioned, the response time to get components, the availability of labor, it all plays into sublimits, what's available in your coverage. And ultimately, for everybody on this call, we're all involved in the ecosystem to provide contingent capital when losses happen and to make sure that happens smoothly. And so the smoothly is the word that's pulled out of that equation when you have a value disconnect. And so whether it's BI, whether it's PD, it's something that's causing some friction in the industry right now for a lot of buyers.
And that obviously includes the impact of all these replacement parts being spread all over the world and rushing costs, correct?
Absolutely.
Thank you.
I think there's a couple of other interesting things that have been going on. On the other side of the world, you may or may not be aware of the fraught relationship between China and Australia at the moment, and China's been turning off pipelines for coal and all sorts of other things. Everybody thought that was going to decimate the coal industry in Australia, and within days, India and others stepped in and took up every bit of coal that the Chinese were not buying. So they barely missed a beat. But then you're seeing other things like Indonesia suddenly turning off the export pipeline, saying for 2 months we're not shipping any coal at all, and things like that. So there are geopolitical things happening which are influencing the markets, and most of them seem to be influencing it to push the prices up rather than down at the moment.
Right.
And one of the things that I feel, especially with some of this maintenance issues and as far as acquiring replacement parts, is that some people think it's as easy as there's a show when we were kids, Fraggle Rock, where they just kind of did some mining and stuff. It was on HBO. It's not that easy. And we're seeing losses where we're getting questions and asked to request information like, what can they do to speed up the process? Can they add more throughput to a sag mill? Could the ball mills run harder? All these things, the high grading issue we'll talk about in a second. But one of the things that I find, I wouldn't use the word unfair, but I think it's unequitable, is to expect a mining company to do everything in their power to mitigate their loss when it impacts their operation long term. And we've seen it where we've had long tail mining claims where our immediate response was mitigate. And then because it was long tail, that mitigation arose other issues towards the end, which was replacement or replenishment of stockpiles, other things like that. I wanted to kind of open it up to the panel to comment on that specifically is, these operational schema changes for a short period of time. What are some of the impacts that we would see, Dr. Chris and Tony, from your experience? What does happen when we shift operational schema, or we push an insured real hard to do certain things to mitigate the loss, but not taking into consideration normal operations? And from a forensic accounting standpoint, I look at these scenarios all the time and I just report the scenarios, but I'd love to hear a bit more from the actual real world response or the real world effects of this.
Well, I can offer something here, Joe. I think these are all personal observations, but it's what I do every day. It's what I do for a living. And when you have an operating mine or an operating energy project, which I also get very heavily involved in, everything's going fine. It's just another day in the office. If people still go to offices, I don't know, but it's just, that's how things should be. Now, what distinguishes a loss event or a major loss event is now things aren't going as planned. And if you've got a functioning project, particularly a remote project, then the people particularly that are involved in the day-to-day running of a mine. As soon as you have an event that requires you to change, such as looking at ways of mitigating the loss, of recovering some kind of schedule or whatever it is, that requires a different skill set. And those people are not necessarily are likely to be at the project location. And as Tony said about people leaving the project, this is a problem that's been going on for a while anyway, particularly from the mining sector, as the mining was made a pariah, is that other people, even in the industry now, that can pick up these unusual situations and be creative, be inventive, be smart, and find a solution. I can tell you that they are in short supply, and they're becoming increasingly short supply. And so it's all very well saying, guys, come up with a solution. Oh, you got to find the people that come up with the solution. Where are the brightest? Where are the smartest? They're doing things that begin with bio and eco and enviro and nano, and they're not. And there was a time when they used to say that people used to study civil engineering because you couldn't get on a mining engineering course. I'm afraid it's the opposite now. And so I do think that that's a real problem, is that having high hopes of a mitigation solution versus the reality of the resources that you've got to solve the problem.
Yes, I think this is a major issue, and I think there's a bit of an issue in a lot of the insureds, where a lot of the operations where they just expect that they've got all these great people who know how to dig a hole and process ore, and that they're just equally capable of responding to these problems when they arise, and in a broad brush thing, not just how to optimize their operation in these circumstances, but how to recover, the logistics, the whole thing. They just sort of seem to think it's all going to happen in-house, and a lot of times I think Nero's fiddling and Rome's burning, and they've got no idea that Rome's burning. I just lost my train of thought for a second. If we're going on to this question of high grading, I think that a lot of people think this is the panacea when something goes wrong. Oh, we can just high grade and make up what we've lost while this plant's been down. But there are huge issues in the mining operation long term, not just during the insurance indemnity period, but way beyond that for the operators. If they start high grading, high grading might benefit in the short term in terms of making up some of the lost production during the insured indemnity period, but it can leave lots of problems later on. And there's an issue here where spending a certain amount of money to process higher grade ore and get a better result now means that longer term people are going to be spending a lot more money to process lower grade material to try and get what they were going to get originally with that mix of high grade. But there are also other issues which occur once you get that material into the process. Most of these mines have been optimized, or most of the process facilities have been optimized for a certain grade of ore or a range of grades. And if you suddenly start putting high grade material through these plants, a lot of them aren't geared to maximizing the recovery when you've got high grade material in there. So you can be actually pouring some of the product down the drain because the equipment's just incapable of recovering it all. But then when you turn around later on and they have only got low grade material left, you've got throughput constraints. You're now putting through a material that's got a lot less of your end product in it. You're still spending the same amount of money to process it, and you're getting a lot lower return for that money out of the product you're producing longer term. And so there's lots and lots of difficulties here with just assuming that you can high grade things, and also most of the plants have got bottlenecks, so you can't just wind the knob up and pour more ore through the process. They're already probably constrained one way or another, whether it's milling capacity, whether it's flotation capacity, or whatever it is in the process. There'll be a bottleneck there somewhere that can't easily be overcome. Otherwise, they would have long time ago and be putting more ore through the plant. So it's not as simple as just cranking the plant up to try and mitigate what they've lost during the indemnity period.
And I think that's part of it. And I've worked with Ryan for a long time. I've known Ryan, and I know Lockton does a lot about educating their clients on that. I can't speak to the other brokers as much because I've worked a lot with Ryan and Lockton on the mining side. But one of the things that I do feel is really important is that pre-risk survey and really understanding the risk that you're insuring, not just from an underwriting perspective, but also from a claims perspective, right? And these scenarios that we're asked to calculate or to model when a loss occurs, I personally feel, and I'd love to hear comment on it from anybody on this panel, is we should have some pre-risk aspect of that. You know, if there's a new SAG mill being put in and you have dual SAG mills, is the primary crusher strong enough? Does it have long enough useful life to operate with a dual SAG mill schema? Or when we put in a ball mill circuit, you know, is our recycling optimized? Things like that always seem to be these quick 5 years, but quick fixes for a 100-year mine in Latin America specifically is my experience with copper. And I look at some of these, you know, comments on a new risk and they install a new piece of kit. And all of a sudden, when they ask to be insured for, you know, another 30%, the scenarios that could impact that BI are not well known or not explored prior to underwriting that risk. From a forensic accounting perspective, that's what I've seen. I'd love to know from a broking or from an expert perspective if you guys have seen the similar context or agree with the notion of doing some more pre-risk exploration before we, you know, bind a policy or before we go to market in London to see if we'll get Lloyd's backing on a mining risk.
And Joe,
Well, again,
no, go ahead, Chris.
that's right.
I was going to say, in my role, Joe, as you know, I was a risk manager for a mining company before coming to the dark side. And, you know, a lot of what we did to evaluate, kind of, if you think about the supply side is insurance, the demand side is the risk side, right? What is the risk? We found a lot of value in doing tabletop exercises, not just saying, if we lose this, if this catches fire, if we have a collapse, but it's in an ecosystem, right? It's within, okay, this happened, but what are the other underlying factors? And the underlying factors are your availability of labor, your availability of parts. What do you do with your near-term customers? Do you lose them? Are they willing to defer? Can you meet their supply over time? What is the availability for third-party substitution? Do your contracts allow that? So it goes through a whole litany of factors that you're never, ever going to nail a scenario and then it happened. You say, hey, I've got to play in the playbook. But it does take that planning to run down a few scenarios where you throw out good case, worst case, medium case scenarios for some of these different levers that can drive outcomes. And that at least starts to get your wheels turning. And it's your contracts folks, it's your marketing folks are dealing with your customers, it's your supply chain capital investment. I mean, jumping back to Tony and Chris's point on the mine, you know, I've always found that, you know, high grading is something that's just, it sounds great on paper. You can't do it. You're talking about an asset that has a plan that is at minimum a useful life of 10 years, at maximum it's 60 years. And so in a normal day, our clients are mining a product, they're getting an ore grade, they're sending it off, they're sampling it, they're running it through their beneficiation process, and they see that the geology is slightly different in the panel that they're in. So they'll tweak and they'll adjust their mining plan, but they might correct the yield over a 90-day period if there's slight changes in mining. The idea that you're going to work around a disaster in 60 days and fix it without any impact to the mine life is just something that's really tough to get your arms around. It's something to me where, to your point, Joe, if you can educate insurers, insurers that have the geologic expertise that understand this, you don't run into claim scenarios where people are butting heads because you have people that are able to process the information in a similar fashion, not have this very kind of imaginary view as to what you can do in that near term to avoid loss, because it's in most cases not possible.
Dr. Sneer, Tony, anything to add?
Sorry, yeah, I was going to go out. Just, I suppose it's apt that I'm calling from Chile. But on 2 points, first one about the risk surveys. I've found as I get older, and now I'm supposed to be nudging retirement, that you can ask more and more awkward questions. And I find that with the risk surveys, you know that when you're doing it and you're talking to people, that they are knowledgeable, they're experienced, they have resources. But the responses you often get when you're asking about something with regard to risk, for underwriters' risk, for example, it's often, well, why do you need to know that? We've told you. So, go and tick your boxes and give us a gold star. And I might be upsetting some people, but I do feel that with risk surveys, we need to be a lot more probing. And if that's uncomfortable, well, tough, and I do think we can tweak out more on some of these risks, particularly when we get to the geotechnical and geological aspects, where I'm from the same cloth. I know you can't give exact responses to geological and geotechnical questions, but it doesn't mean to say you can be dismissive of the question itself, and acknowledging that the question is valid is in a way a form of risk management. Having the answer is an extension of it, but it's this level of denial on geological and geotechnical problems that does bother me with risk surveys. And so when you do have an event that results in an interruption of the business, you start asking these questions, it becomes even more awkward. But that day will come. You're just putting it off. The same thing I'd say is about particularly with the high grading, is that, and as we've been pinched on, is that you're changing the nature of that mine, of what that mine was that's been operating for however long. It has a characteristic, it has a DNA, okay? And you have an event, you decide to alter the way you do something, such as high grading, and you're changing that. And it does take that amount of time, and it may not be efficient. You may need a lot of the same stuff to do that you would need to do to solve your problem in the first place. It depends, but at the end of it, the question is, what have you got as a mine? Because high grading isn't something you can just turn on and turn off, as Ryan says. It can be there. There can be a legacy of high grading that you have. And so when it's all over and the business is back to functioning, you've solved your problem, there's no more business interruption, it's now a functioning mine, but it's not the same mine it was before it happened. So what are you actually looking at as an insurer now because of that? And even if you do say, well, we've demobilized or we've decommissioned any high grading operations we've got, you probably still have a legacy from that high grading.
Yeah, that's exactly the point. I think that some kind of a meet together scenario where underwriters and brokers communicate via insureds, getting together to make sure these pre-risk surveys incorporate some more information. For us, from a BI perspective, would make our job a lot easier. And we are developing some technology with Stratus to do that for some of the simpler risks. But in a complex risk, if we knew some things before we got involved and we were part of that pre-risk process, it would be a lot easier for us to look at these scenarios and respond quickly for mitigation. The question is, can you run this for us? And they're looking at making quick decisions. And I know, Tony, you deal with that stuff with mitigation specifically, and you're called in to look at, procurement and, speeding up the process. But do we all agree that that's something that we should strive for as an industry, is for this more, togetherness when it comes to understanding the risk? Because I am an advocate for it, and I will advocate for that, as we go forward in the mining space. But I wanted to just kind of get everyone else's feel on it.
Yeah, Joe, I don't ever see risk surveys when they're done. I generally see them after things have gone wrong. They're given to me just to give me a flavour of what the operation's like. And I continue to be underwhelmed by what I see in these risk surveys. I mean, you've got projects that are worth billions and billions and billions of dollars, and some guy spent 3 days wandering around the sites to do a risk survey that's the basis for the underwriting for the next 12 months. And time again, I see that the thing that's actually gone wrong has never even come on his radar in the course of these surveys. Major equipment and that sort of thing. You know, the surveyors get lost in fire extinguishers that aren't on the wall and leaking oil from a transformer and that sort of thing, and they miss the side of the barn. So I'm not sure that, and it's also driven by the fact that risk surveys cost money, and people don't want to spend too much money on this sort of thing, even though there could be some substantial benefits if they were done properly. The other thing that I find is that there's been in the past some naivety about what the magnitude of some of these risks are. If we cast our mind back 10 years to when gearless mill drive started to become a real problem and the SAG mills in South America, the very first one of those that went pear-shaped was able to be nursed along for 18 months or 2 years. And then when the time came to replace the gearless drive, it took 45 days to dismantle the old drive and put the new motor in. And insurers took the attitude, oh, well, you know, we will put a 45-day time deductible on these things when if we insure them. That 45 days of downtime came after nursing this machine along for nearly 2 years, after 12 months of manufacture in the plant in Spain, after shipping the thing across the world, and after getting it to the site ready to install. And then there was the assembly of a huge team of contractors to do this job. There was 9 months of planning to reduce the critical path on the change out from 63 days to 45 days to get all this 45-day to actually happen. And there was just, I think, total naivety about the actual exposures when some of these things go wrong, because no one's carrying a spare drive for one of these machines. You know, the motor weighs 500 tons and comes in 4 pieces. No one's carrying a spare for them. So if something does go badly wrong, you could be looking at 18 months, not 45 days.
Yeah, Chris, you wanted to say something?
Yeah, I just pondering on what Tony said about the 3-day risk survey. Absolutely bang on. I'm thinking now that maybe in the last 10 years, if I took some of the losses, particularly the RCAs I've had to do for some of the bigger losses, I think if you took about 10% of the cost of that RCA, you would have a really good chunk of time to do a risk survey.
Yes, everybody's prepared to spend the money after it's all gone wrong.
Yeah, and it's something that maybe, well, not something that they should dwell on. You know, how realistic is that 2-3 day nip in and nip out? And again, not wanting to upset anyone in the mining industry, but you know, to sit there and listen to a PowerPoint presentation about a $1 billion project that you know, that has got years to run and has been years in the planning. You know, it's you're scratching the surface, and sometimes you do have to dig deep in a risk survey. And as I said, sometimes you might have those awkward moments, and I think that they're great. I think they're extremely healthy. And a silence when you after you ask a question is a healthy thing.
I think the other thing that tends to happen in these surveys, Chris, is that they get done the first time, and then that becomes the template for all the subsequent ones. They come back and they look at the same things time and time again. Oh, they've fixed that. I've seen another problem there. But it's sort of almost tunnel vision once the initial framework's set up, rather than looking more broadly.
Well, what we have, you know, with the tunneling world, which is, you know, I'm an underground person. I do a lot of tunneling work as well, and you know, we have the ITIG code of practice, which is a much more formulaic method of carrying out risk surveys, and it's a great document. You know, it sets out the rules. You know, for the insured, for the underwriter, for the risk engineer, for all those involved. This is the rule book, and it has a spirit to it as well, a spirit of honesty and transparency, and it's a great guide. And it does, you know, what you're saying is lacking in some of these, Tony, in that it has a chronology to it. You know, it follows the life of a project in construction. We're talking about now, and recognizing these big differences between procurement, commencement of construction, peak construction and commissioning, etc. And so when you have the risk survey program that parallels the life of the project, you get good results.
Well, I think all that is really valuable. I know Ryan's sitting there thinking, because he's doing a lot of work in this world, and kind of bridging this gap. So I appreciate everyone here. I wanted to open up to questions because I think that we ended on a very important topic. I think values at risk, doing the surveys, understanding your risk are all things that the mining industry as a whole just needs to get better at, so that when the losses occur, it's not such a surprise that this is a huge loss. You know, and you're in Chile, so you know that all these, you know, sub-extraction biolixiviation facilities, we see a lot of those things because of a processing plant kind of get put to the wayside when it comes time to looking at an asset. But if you can't make a cathode, you can't have any refined products out of the mine. And sometimes I look at things from a BI perspective and I ask that question, you know, where is the loss? What part of the mine? Because if it's something midstream and we can screen it or reprocess or use a ball mill instead of a sag mill, yeah, you're going to lose a percentage. But if you lose your final process before you ship product, it's those little nuances that I think is the reason why experts like Dr. Chris and Tony and brokers like Ryan exist. And I encourage underwriters to really reach out to these experts, from my experience, because we do have insights that others don't. And I think insureds are doing the best they can to try to navigate this environment. But, you know, I went to RIMS and I talked to some of the risk managers, and it's tough right now. It's you know, not looking for sympathy for insureds. They're running their business. But I am saying that as a mining industry, if we're going to do this and collectively, I think we all need to meet in the middle ground a bit. So again, thank you. Any questions at all? We'll take any from the group. If not, we can wrap up with some final thoughts. I don't see any questions. All right, panelists, just one final, we have 2 minutes left. Any final thoughts?
I would just give you a quick comment, just jumping in a little bit on what Chris and Tony had mentioned. The hard market that we've seen over the last 36 months for property, specifically around, you know, the mining and technical risks, it has demanded better engineering. So I think both of you guys, as you see reports going forward, you're going to see a little bit better quality in terms of the risk reports, specifically for mining, because you've got mining underwriters that are just demanding it. They won't accept a broker-based engineer. They don't want to see someone who just has fire knowledge. They, you know, many of our clients that have tough geological issues are actually using 2 different firms, one to do the boiler machinery and fire, and one to do the geotech issues that may be associated with it. So it is getting better. I would agree with you wholeheartedly that the history of these reports don't help a ton. I think they're getting better. So hopefully we'll continue to see some improvements.
Tony, Chris, any final thoughts as we depart?
My final thought is don't be afraid to put someone's nose out of joint. You can always put it back in.
Yeah, they say there are 3 types of people in this world. There are the people that know, the people that know that they don't know, and the people that don't know that they don't know. And one of the problems is just getting a measure of what you're actually dealing with when you go and do these go to these sites and talk to these people.
That's a good point, Tony. All right, well, thanks to everybody. Danielle, anything? Carlos?
Yeah, I was going to say, as we wrap up, we'll continue to watch how the environmental and sustainability issues continue to drive this governance risk and some opportunity there as well.
Yeah, and these three panelists will be going forward. We're going to look to them for our learning center and to promote some of their content. For those that don't know, Ryan runs North American Large Loss Symposium, or Complex Risk Symposium out of St. Louis on behalf of Lockton. Underwriter support is very useful in the mining space. So anybody that wants to know more about that, contact Ryan. We'll make sure everybody has the list of who attended, and we'll get some conversation started. But look forward to our Learning Center, future webcasts, roundtables, seminars. We're really looking to drive education in the mining space. I really feel that's something that I'm passionate about, because I think the more education for the mining space, the more respect that we can garner as experts. So thank you all for attending, and have a great day, everybody.